about assets that are financeable that the bank will finance. I think you're talking about receivables, inventory, fixed assets. And Pat mentioned airball, so I wanted to talk a little bit more about what that means, what the multiples are that a bank will finance on from a cash flow perspective, and what the terms of that financing might look like. So, Jim, why don't you start with that? And Kevin, you can say what you do when you're looking at, when we went through the first transaction, you had the bank on board, how you got the bank on board to do the transaction, what sort of projections we give to the bank when you're going through a transaction to get them comfortable, and how much, I'll say, cushion you put into the numbers. Kevin's done a number, probably over 10 transactions. To date, he has never missed a projection that he's given to the bank. Very easily. Is that correct, Kevin? And he has a great relationship with the bank. Go ahead. Jim, why don't you start?
Sure. I think when in terms of the expression airball, that is what is used to reflect lending that's primarily driven on supported by the cash flows that are being generated by the business, as opposed to the underlying asset value or liquidation value of assets within the business, whether they are AR inventory or some types of fixed asset, machinery, equipment, or in some cases maybe physical plant. Again, when you're in terms of borrowing, size matters. The bigger you are, the more cash flow you generate, the more leverageable assets you have, the more scale, the less customer concentration exposure you may have. Those are all factors that as you get bigger, you are able to borrow more. When you're looking at middle market or lower middle market transactions, banks oftentimes, senior lenders or traditional banks may tap out at 2.5 times your cash flow, or may just be focused on whatever it's 75-80% of eligible accounts receivable. It's 50% of eligible inventory. It's 75% loan to value on fixed assets. So or something along those lines. Usually there's some sort of formula or something of that nature, and maybe they're willing to stretch a little bit more above your sort of formulaic asset values into that airball piece to reach a little bit more to help finance the transaction. One of the things I think that a lot of middle market and lower middle market business struggle when they're looking to secure financing for the transaction is developing not only projections for their own business, but projections for the combined business. It may not be an exercise that they may do a budget, they may not, but typically banks and other financing providers are looking for multi-year forecasts to show basically how are we going to get repaid. And that's an exercise they may not have been engaged in, and it can be difficult for them to do the first time around. And you have to be careful with spreadsheets today. You can make them say anything you want them to say, but it's a garbage in, garbage out scenario. You have to be realistic about your assumptions, your own business and the business you're acquiring. Banks like positive surprises; they don't like negative surprises. So, to what maybe Kevin is, there's the art and the science, but making sure that you're showing the bank what you need to secure the financing you need for the transaction, but not getting too rosy where you're explaining why you're missing these forecasts as you go through the process.
Okay. Yeah, I think we had mentioned before the process of giving multi-year forecasts. We do a 5-year look forward of combined entities. The size of the entity has a lot to do with it. You can cover a lot of sins, shall we say, when your core company dwarfs the acquired company. You can creatively work around issues, but that's kind of how we go through the process with the bank. Take a look at a projection that we get from a potential target, and we take a look at stressors and really give the bank the pessimistic view, of what could happen, and make sure that meets the minimum requirements for our covenants. But also, we don't want to paint the 90 percentile probability out there. We use something far less than the 50 percentile, and Jim said the bank's always happy with upside surprises and not so much with downside. So we've developed our relationship with the bank where we essentially have an acquisition line, if you will. The bank still has the ability, based on size requirements, to approve certain things. When the size of the acquisition is at a certain level, it's really just notification that we have. So we have an agreement with them that if we go through our due diligence and look at the additive value of the two companies and it's at a certain level, we'll just let them know, hey, we're going to do this. We'll give them all the documentation, but they don't have really a right to veto it. If the size gets big enough, obviously, then we have to go through. And we always do give them back briefs before we complete the transaction, explaining exactly what happens. So I think it is important for that kind of relationship to be fostered.
Couple of angles. I agree from an insider's point of view, as my banking background. It's very important to give as conservative projections as you possibly can to the bank, and just know that the bank is going to look at those projections, and that's all they're going to do, because banks like to look back. We all like to look forward at what we're going to do and why this makes sense for us. Banks like to look back and see, all right, what has this company done in the past, and can what they've done to date support what they're looking to do in the future. So they're going to look at your projections, they're going to say, that's great, we want to see something that makes sense for you to go forward. Now we're going to analyze this and say, okay, where your cash flow is today and combined or on a standalone basis, can that support what you're looking to do? Most times banks don't want to rely on heavy growth in order to pay themselves back. So they're going to look at it and they're going to analyze and say, okay, at 12/31/13, this combined entity actually produced X amount of EBITDA. And that X amount of EBITDA, can that support the amount of loans that we're looking to put on the books? And that's how they're going to do it. And typically what they're going to put in place is two major covenants, a leverage covenant and then a fixed charge coverage covenant. And those are going to be the two drivers for them. And for leverage, it was noted before, the more or the less collateral that you have, so the larger the collateral shortfall, typically the tighter the leverage covenant's going to be. So if you have full collateral coverage on all the debt you're looking at, you're typically going to be able to get 3 times leverage, maybe even a little bit more. As you get into the collateral shortfall, the airball piece of it, that's when they're going to drive that leverage number down. It's going to be closer to 2 to 2.5 times. And where we've seen success in structuring transactions with the bank has typically been one where we identify the working assets, which provide us a line of credit. So that's your receivables and your inventory. So that will give you a borrowing-based type of line of credit. Then we see what are the actual fixed assets that we have, the M&E and the real estate. That will give you a term loan that may even be able to be extended amortization-wise. If it's real estate, 15 to 20 years. If it's good equipment, it could go up to 7 years, and you can get the best interest rate on that piece. And then you identify what is the truly collateral shortfall piece of it, and then that piece you're probably going to pay a little bit higher interest rate, and the structure is going to be slightly different. A structure that we've always done now in the last 7 deals that we've done is that piece has been amortized over 5 years with what's called an excess cash flow recapture, which is to state that, okay, you're going to have this scheduled amortization of this, but if the company basically outperforms what we thought they were going to do and creates this excess cash flow on an annual basis, we want you to use a portion of that excess cash flow to pay back that airball term loan. And that's been a structure that's worked for us, it's worked for the bank, and it keeps everybody happy.